Welcome to a short video about financing the business and ultimately a very current topic, the IPO or initial public offering. Every business, no matter how large and complex, is ultimately financed with a mix of debt, money that you owe others, or equity, owner financing. So we consider debt financing the long-term borrowing from a source outside the company, and equity financing is using the owner's funds or internal funds as a source of the long-term financing. With a small business or a new startup, financing may take the form of borrowing from your parents, taking out a second mortgage, using credit cards, or what we call love money. Friends and loved ones support your business. It could all even take a source such as GoFundMe, where people pledge donations to support a company in exchange for first dibs on the company's product or service. With a publicly traded company, debt can take the form of bonds that the corporation issues, and equity is usually common stock that is issued by the corporation. In a private business, debt is more likely to be bank loans, and the owner's equity represents their savings. If we look at loans, there are several terms to become familiar with. Borrowing money from a bank, from others. A secured loan is a loan that's financed and it's backed by the borrower pledging the asset as collateral to the lender. So you can think of this as analogous to a car loan. You borrow the car, but if you don't pay on time, they'll come and repossess the car. So that asset, the actual physical automobile, is the collateral. The loan principal is the amount of money that is loaned and has to be repaid, and usually the terms include interest, even in these days of still low interest, and the loan has to be repaid. And as we discussed previously, if you borrow $10,000 on your student loans, you'll pay back more than that $10,000 because you're being charged interest. An unsecured loan, such as a student loan, is a loan for which you don't have to pledge any collateral. So there's nothing for the bank or the loaning entity to come and repossess if you don't pay. And that is one of the reasons that they have justified charging higher interest rates for student loans, is because they aren't secured. Corporate bonds are commonly used by publicly held firms to match their mix of debt and equity financing with the long-term and short-term financing needs of the corporation. So bonds are usually repaid at over a long period of time, and how it works is that they pay interest periodically, and when the bond matures, can be a period of anywhere from 10 to 30 years, the principal is repaid at that time. Having a good bond rating, and this is something that you can find for a publicly held firm, doesn't guarantee, but ensures that you will receive the most favorable terms when you issue the bond um, debenture. And these securities, then, if you have a poor grade, if you're a C to a D, while you may be able to finance with this type of debt, you're likely to be paying a higher interest rate. So you can view these grades as similar to your credit score. If you have a high credit score, you're going to get the lowest interest rate. If you have a low credit score, you're going to be paying more. Young firms, think about the types of companies that you see on Shark Tank, will often use not debt financing, but ownership financing. So they'll exchange some ownership in their firm for an investment of cash in the company. Angel investors are outside investors who provide new capital for firms, and then they'll get a percentage of the ownership of the company. And venture capital basically is wealthy individuals who are seeking opportunities because they see promise in the new growth companies. And if you have ever watched Shark Tank, often they'll say, I'll give you $100,000 for a 5% ownership stake in your company. And that is creates a conundrum for the owners of the company or the founders of this new company, in that they want to seek to retain control of the company, but at the same time, an infusion of capital would allow them to grow. In order to fuel growth, many companies consider becoming a public corporation, and that involves an initial public offering, which we commonly refer to as an IPO, which is the first sale of a company's stock to the general public. In 2012, Facebook had one of the largest IPOs in history, raising $100 billion in a very short period of time. Its opening price was $38 a share. And recently, from 2017, the growth in IPOs has increased dramatically. The amount of funds for all the companies that had an initial public offering increased dramatically, 62%. And analysts are predicting that 2019, if the economy holds, is going to be a record breaker. IPOs have many advantages, and they also have some drawbacks. If we look at the advantages to an IPO, the primary number one reason that companies want to go public is because it gives them access to money so that they can fuel their growth. The biggest benefit is the capital raised. It can fund research and development, pay expensive, pay off previous loans, pay back the love money from mom and dad. And it often generates a lot of publicity, introducing consumers to the IPO company, which they might not have heard of before. It offers improved corporate governance, With an IPO, you're becoming a public company, and as such, you're required to have a board of directors. And that board of directors is there to ensure that the company is being run in the best interest of the now public shareholders. It also gives the company an independent valuation of the firm. Whereas before, analysts estimated the value of the firm, now the stock market creates, I shouldn't say creates, the stock market values the firm. So the value of the firm will be based upon what people are willing to pay for a share of stock in that company's firm. IPOs also offer prestige, along with the publicity that came from an initial public offering. There's the prestige associated with being a publicly traded firm. Finally, there's the founder's exit. This initial public offering enables the founder to recoup their savings that they had invested in the firm and potentially then leave the firm. Another manager will come in to manage the operations of the firm, and the founder can go on to start another company. The disadvantages of an IPO are the potential loss of control. Right now that the company is public, the founder no longer owns the company. The initial team or individual who founded the company, now there's lots of owners, all the shareholders. And as a public company, the firm is now subject to the SEC rules and regulations, and these require extensive disclosure about the operations. Think about the 10K forms that are required to be filed with the SEC every year and other regulations. And the 1934 Act really created a burden, and many owners of firms, especially young and relatively recently started firms, don't like the rules of the SEC. Additionally, there is substantial evidence that private firms outperform public firms. And part of this is due to the rules and regulations that a public firm has to follow. It's expensive. So if we're going to go with an IPO, what affects the IPO success? How are we going to be able to raise the most capital from our initial public offering? And the literature, the research that's been done by finance researchers and economists suggests that the founder characteristics, that is the CEO, what their experience is, and the board composition, that is, does the IPO already have a board of directors that looks like the board of directors of currently publicly traded firms, which signals to the market that they're ready to become a publicly traded firm. Additionally, venture capital plays a role. Firms that have venture capital investors are more likely to garner a higher IPO share price. And then finally, the industry that you're in. There are certain industries that are favored for IPOs, and so you can think of industries today that are tech heavy. So future IPOs that are coming up include Uber and Lyft and some software companies, and those are viewed as more attractive initial public offerings, and that affects that initial price that they'll get for the stock that they're issuing. To conclude our discussion, ultimately, the value of the company is going to be determined, if it becomes a public company, by its market capitalization. So the market cap is the total value of all the company's outstanding shares. So what you would do is you would take the current stock price times the number of shares outstanding, and that will equal its market capitalization. And as you read the business news, they often talk about market cap. The most famous example is when the market cap of Apple for a short time exceeded $1 trillion. Thank you for watching this short video that turned out to be a little bit longer. And happy studying.